Hey everyone, welcome back to another recap podcast from SNXweave, where we give quick weekly recaps of news and important updates from the previous week from the Spartan Council and core contributors. Let's get started. Last week, Fenway gave the community an update on SIP 420, so let's dive into that first. The CCs have been working on migration and setting up the pools for users to migrate to. Fenway is confident that this will get to market for pre-release soon. There was an announcement last week for any migration testers who want to enter the new SIP 420 staking pool during the pre-commit period. He then went on to explain the rationale behind the decision to transition from discretionary to delegated staking. Historically, Synthetix users have not been great custodians of SUSD. The stablecoin is minted to stakers and oftentimes makes its way to users outside of the community who have no real use for SUSD, which creates downward pressure on the peg as debt mounts against the outstanding SUSD balance. In a delegated staking model, the protocol would become the sole minter and manager of the debt. It will also allow for a more strategic deployment of SUSD across yield opportunities, including Athena, Aave, and other yield instruments. The goal is for the proceeds of this yield to accrue directly to stakers, as opposed to a buyback and burn strategy which accrues to all SNX holders. This provides an individual incentive to stake to the delegated pool rather than just holding SNX. Another incentive to stake is the planned debt relief over a 1-year period, with a heavy penalty for early withdrawal. Only 12.5% of a staker's debt would be relieved if withdrawal occurs before 6 months. 50% of the debt would be relieved for withdrawals between 6 and 12 months, and there would be 100% relief at day 366. Nobody will ever owe more debt than they initially delegated to the pool, and there will be no liquidations for users delegating to this pool either. The delegated staking model also allows for the protocol to direct SUSD liquidity across the Synthetix product suite, which would improve user experience and bootstrap liquidity for newly launched products. Next, as a quick base update, volume has been strong in recent days, topping $50 million a day twice last week. There was a minor error in the stats that were showing a much lower APR for LPs than they were actually receiving. The correct yield is 30%, which should attract more LPs. There have also been several UI improvements recently, and account abstraction should be coming soon as well. During last week's call, there were some questions from the community regarding SIP 420, so let's briefly review them. The first question was, how do you migrate? Fenway said to be on the lookout for more information for early testers. Next, someone asked what happens if you stake SNX that doesn't have any associated debt. Phase 1 of this release will be to migrate all the debt positions to the delegated pool. Phase 2 will include some incentives for debt-free SNX to delegate to the pool as well, with the incentives being added in place of the debt jubilee. A community member also asked who the pool is governed by. The pool will be governed by the Spartan Council, and an SCCP will be required to create guidelines on how the debt is to be used. Lastly, it was asked if there will be any priority given to arbitraging the funding rates. Fenway said CCs are looking at developing vaults beyond just LP vaults that will enable the protocol-directed pool to fund arbitrage and capture basis trade yield from the Synthetix exchange. Any organic use case for SUSD, such as using it to facilitate trading activity, is much more attractive than incentivizing curve pools, and those options are being actively explored. And that's it for today's updates. Be sure to check out our weekly recap blog post, share this podcast link, and let us know what you think and what you'd like to hear more about from SNXweave. Thanks for listening.